Hello everyone and welcome back to Passion Coaching Classes by Sadaf. Today we will be covering chapter number 1, Introduction to Accounting Standards from the Advanced Accounting Syllabus. This chapter is fundamental because it explains the framework that governs how companies present their financial information. By understanding accounting standards AS, you will be able to comprehend how business handle accounting and reporting practices. Now, let's break down what we will cover today. These are the topics which we are going to cover today's video. What are accounting standards? Let's start with the basics. What are accounting standards? Accounting standards are a set of rules or guidelines issued by regulatory bodies to ensure that companies prepare their financial statement consistently and transparently. These standards help maintain uniformity in the financial reporting process so the investor, creditors, and other stakeholders can understand the financial performance of the business clearly. Example: let's say you own a bookstore. You sell a book to a customer, but the customer asks to pay later. When should you report this transaction? In accounting standards like AS9, revenue recognition tell us that the revenue should be recognized when the book is delivered to the customer, not when the payment is received. This is an example how accounting standards guide businesses in reporting transactions consistently. Now, we are going to cover the second topic, need for accounting standards. You may wonder, why do we need accounting standard in the first place? Without these standards, every company would use different method to account for similar transactions. This could lead to confusion and make it difficult for investor and stakeholder to compare the financial health of the businesses. For example, imagine two companies. Company A recognizes revenue when goods are shipped, but Company B recognizes it only when payment is received. How would you as investor compare these two companies? Accounting standards ensure that both companies recognize revenue in the same manner when the goods are delivered, making comparison easy and fair. Now move to the third topic, objectives of accounting standards. The primary objective of accounting standards are uniformity, ensuring that companies follow the same rule while preparing their financial statement. Transparency, providing clear and truthful information about the company's financial performance. Comparability, enabling comparison between different businesses by ensuring that financial statements are consistent. Now, to get you easily understand these topics, we are introducing some examples. Think of accounting standards like a referee in a sports game. Without the referee enforcing the same rules for everyone, some teams could have an advantage and the game would be unfair. Similarly, accounting standards ensure all businesses report their financial result in the same way, making the game of business fair for everyone involved. Let's cover topic number 4, structure of accounting standards. Now let's understand how accounting standards are structured. Each AS typically has the following sections: objective, scope, recognition, and measurement. In objective, this explains why the standard exists. Scope, it identifies which transactions the standard applies to. And recognition and measurement tells business how to recognize and measure transactions. Then presentation and disclosure. This explains how financial transactions should be presented in the financial statement. Now, for example, take AS10, accounting for fixed asset. The objective explains that this standard governs the treatment of fixed asset like building, machinery. The scope specifies that it applies to all entities that have fixed asset. The recognition and measurement section guides when and how to account for asset. For example, it explains that the purchase cost of an asset includes the price and any related expenses to bring the asset to its current location and condition for use. The presentation and disclosure sections tells companies how to show these assets in their balance sheet. Now move to fifth point, that is applicability of accounting standards. Accounting standards apply differently based upon the type and size of business. For smaller businesses, some standards might not be applicable, but larger companies must comply with all relevant standards. For example, a small bakery may not need to follow the same complex accounting standard that a multinational corporation does. For example, smaller businesses might be exempt from certain reporting requirements. But a large corporation with international operations must comply with all the standards to ensure transparency and consistency. Point number 6. ICAI's role in issuing accounting standard. The Institute of Chartered Accountant of India (ICAI) is the primary body responsible for issuing and updating accounting standard in India. Point number 7. Overview of key accounting standards. ICAI has issued 29 accounting standards. Let's go over a few key ones that are essential for your understanding. Now move to AS1. Disclosure of accounting policies. Now, this standards requires companies to disclose their accounting policies in the financial statement, explaining the method used for various transactions, like fundamental accounting assumptions and accounting policies. AS2. Valuation of inventories. This standard guides businesses on how to measure and value their inventories. It ensures that inventory is valued at the lower of cost or net realizable value, making the financial statement more accurate. Now talk about Accounting Standard 9, Revenue Recognition. AS9 explains when and how revenue should be recognized. For instance, a company must be recognized revenue when the risk and rewards of ownership are transferred, not when the payment is received. Now AS10, Accounting for Fixed Asset. This standard guides how business should account for their fixed asset like land, building, machinery and equipment, ensuring that these are reported correctly in the balance sheet. ICAI consistently updates accounting standards to keep up with the latest economic development and international practices. For example, new standards like IND AS, Indian Accounting Standards, are designed to bring Indian businesses closer to IFRS, International Financial Reporting Standards, to align with global accounting practices. For example, the adoption of IND AS 115, revenue from contract with customer, brings Indian standard closer to international practices, ensuring consistency for multinational companies operating in India. The ICAI is responsible for issuing and updating these standards to ensure that they remain relevant. I hope you found this lesson on Introduction to Accounting Standard helpful. Please leave any question in the comment below and don't forget to like, share and subscribe to Passion Coaching Classes by Sadaf for more educational content. Thank you. Allah Hafiz. Bye.